Hello, welcome back to Adjunct Instructor, the most exciting accounting program this side of the Mississippi. Oh, brother. Okay. Alright, so last time we were talking about the trial balance. That's where we left off. Collectively, we are talking about the accounting cycle. If you know, the accounting cycle has 9 steps, and we start all over again. It just keeps going and going and going, and it goes on for the time period, the year. Okay, transitioning into this time period thing, you're gonna need to know this for what we're about to get into, which are adjusting entries, step 5 of the accounting cycle, and journalizing and posting adjusting entries. So time periods, we talked about time periods before. Companies want to see they don't want to see financial statements, or investors don't want to see financial statements. Any interested party does not want to see financial statements that expand or are accumulated for 2, 3, 4, 5 years. Okay, that's why we have these artificial time periods. Okay, 1 year, a quarter, a month. These are artificial time periods. Okay, for financial statements. This is the time period assumption. Okay, time period assumption. That's all it is. The economic life of the business is divided into these time periods. For companies, the big dogs, not the lame proprietorships and partnerships and the small mom and pop stores that don't generate any revenues. We're talking about the big dogs that fall under GAAP, the SEC. Okay. So they have to issue quarterly financial statements, yearly financial statements. Okay, could be months to months. That's usually for managerial, but we want to see timely information at the most for a year. Okay, what happened to revenues during the year? What happened to expenses during the year, during the quarter, during the months, assets, and so forth. Okay, so that's time period. Okay, that's the time period. Then you must be, and this is for normal transactions. Okay, normal transactions that occur throughout the period, throughout the year. Adjusted entries occur after the normal transactions have been posted, journalized and posted. Okay, there is a need for adjusted entries, and we will see that after we talk about accrual accounting. We will see why we need adjusting entries. Sorry, I'm whispering here. I don't know. I got sexy for a minute. Okay, excuse me. All right. So, accrual accounting. What is it? Okay. Accrual accounting ties into adjusting entries. Companies that are traded in one of the major financial stock exchanges, uh, NYSE, New York Stock Exchange, whatever, okay? If they fall under the SEC, Congress, and all that stuff, or they are traded in one of the major stock exchanges, they have to follow the accrual basis of accounting. The accrual basis of accounting works in terms of revenues and expenses. Basically, what it says is that revenues must be recognized in the period in which the performance obligation is completed. What is the performance obligation? You selling something or providing a service. Okay, once you have performed that service or sold that or provided that merchandise item to the customer, then your performance obligation is done and you can recognize these revenues. If that has not been completed, then you cannot recognize revenues, even if the cash is exchanged. Okay, cash basis of accounting, throw it in the trash. We don't care about it. Okay, then expenses. Accrual accounting says that the expenses should be recognized in the period in which they are used to generate these revenues. So things like wages expense, things like utilities, things like rent that allow you to generate these revenues. For example, Walmart can't have a store without lighting because the customers can't see if there is no light, and if the customers can't see, they can't pick out the inventory, and if they can't pick out the inventory, they can't bring it to the register and they can't buy it, right? So that's an example of that. Okay, so that's basically all accrual accounting says. Cash basis, again, we do not use. Here is just some repetition in this beautiful PowerPoint. But it's just repetition, okay? And we'll get to see examples of expenses and revenues and all that good stuff, okay? We're going to skip questions in this beautiful PowerPoint because we're going to work through an example, hopefully in the next video, maybe in this video, depending on my mood. Anyways, you're getting this stuff for free. Stop complaining. Anyways, the need for adjusted entries. Why do we need adjusted entries? One major thing is to ensure that accrual accounting is followed, okay? That the revenue recognition and expense recognition principles are followed, which is what make up accrual accounting, okay? It's also necessary because we have normal transactions, and that trial balance, that vanilla trial balance, ice baby, okay, that trial balance may not be up to date as it says here, and it may not contain complete data. Why does it not contain complete data? some some expenses may be prepaid. Some revenue may be unearned. Do you see where I'm going with this? You'll see. Okay, so for example, okay, and some expenses also expire with the passage of time. Let's say you bought a bunch of supplies. Companies do this. Supplies are used internally. Inventory is sold externally to customers. Okay, so supplies may be things like pen, paper, printer paper, cash register paper, um, whatever. Okay, these are supplies that you use. Markers, maybe, if it's like a professional company. These are supplies that you are using internally that you're not selling to the customers outside. Could be things like soap, sanitizer. No. These are supplies that are used. Anyways, every time, let's say you have the supply closet, okay, and you are not gonna book um, an entry every time somebody goes to the supply closet and grabs a pen. For example, a pen is like what, 5 cents, 10 cents, let's say 50 cents. For a multi-million-dollar company, you think they're gonna spend the time um, to make that journal entry for that one pencil? No. What happens is we buy supplies, put it on the head of the company now. We buy supplies at the beginning of the period. And let's say we bought 2,000 worth of supplies, okay? Then, let's say that was at the beginning of that first month's for this new time period, okay? Then, what happens is, instead of recording every time that somebody goes into the supply closet and takes a minute amount of whatever it is, piece of paper or whatever, um, we take a beginning count and an end count. So 2,000 at the beginning, then we have 400 at the end. Um, After we do a count, we find out that 400 is left in the supply closet, 400 worth of the supplies. So we must have used 1,600 of supplies during the months. So what we do is do an adjusted entry for that 1,600. We expense 1,600 of those supplies, and that's it. We expense 1,600 of those supplies. And why I stumbled there a little bit, because you have to debit an expense account and credit the supplies account, transferring it from a prepaid um, expense, which is an asset, to the actual expense, which should have been originally. Okay, see how that works? Confusing, right? That's what I tried to do, is just confuse the hell out of you. Okay, so you can come back to me and maybe let me do your homework for a fee. Anyways, they're required every time, adjusting entries, that you prepare financial statements. It will affect one income statement account and one balance sheet account. Okay, going back to other examples for expenses, maybe some expenses expire with the passage of time. For example, electricity. Okay, utilities, right? Electricity. Are you gonna say, well, I paid $120 for the months for electricity? Are you gonna go day by day and say, well, I used $10 the first day, $20 here, $30 on Sunday? No, you're not gonna do that. That's stupid, right? You're just gonna classify it, um, on a monthly basis. Usually on a monthly basis. Let's say you prepaid for um, the light bill expense or electricity 6 months in advance or something like that. Then you just do it months to months. 120 this month, 120 next month, and so forth is consistent, and that's it. Okay, you do an adjusted entry and everybody's happy. We'll see how it works. I'm rambling too much. Let me stop. Anyways, So those are adjusting entries and why we need adjusting entries. Okay, why we need adjusting entries. Skip the questions. Let's get to the meat of this chapter. Okay, this is usually chapter 3 in most introductory books. Sometimes they have it as chapter 4, which are the stupid books. Used to work for college that did that. Anyways, this should be in chapter 3 so we can move along. Okay, so chapter 3, chapter 4, it doesn't matter. This is an online course. We're just talking about deferrals here. We're all friends, right? Okay, we're just talking about, sorry, accrual, no, adjusted entries. All right, so adjusted entries, two types, deferrals, accruals. Deferrals are postponement, postponement. Accruals are advancement. Hopefully I don't have those two switched up, okay? But those are the two types of adjusted entries for accrual accounting. Okay, so deferrals, postponement. What are you postponing? This is just the way I think about it. Again, it works in terms of expenses and revenues. For expenses, you are postponing the use or consumption of that expense, even though you have paid for it in advance. Okay, you have paid for it. You have already paid for it. So again, that example, rent. Let's say you paid for rent 6 months in advance, right? At the first of the month. Oh, okay. Anyways, so let's say, keep it simple. Rent is $100 per month, and you paid for 6 months in advance, so that's 600. Okay. So when you originally paid for it, this is the original entry. Okay, not the adjusted entry, but originally, even though this is an expense, when you prepay for it for an extended period of time, then it becomes a prepaid expense. A prepaid expense, the beautiful thing about it is that it is an asset, okay? And here's a little secret. All assets, with the exception of a few, like cash, accounts receivable, are really prepaid expenses. Weird, huh? Yes, but they're prepaid expenses, okay? Um, so in this case, we have prepaid expenses when you prepay for them. You haven't used them yet, but you paid in advance, right? So you postponed the use or consumption of this expense. Then the adjusted entry comes, okay, at the end of the period. So initially, you would debit prepaid rent, okay, an asset, and credit cash. By the way, for adjusted entries, the actual adjusted entries, you will never see cash in the adjusted entry. Um, then, when you actually go to that adjusted entry for this prepaid expense, you transfer it from the prepaid expense account to an actual expense account, which is what it should have been originally. So now we debit rent expense for 100, okay, because that's that first month that's expired, that's what we use, that's what we consume, and you credit prepaid rent, and that's all she wrote. Simple, good, done. Yes. Okay, as far as revenues, unearned revenues is another type of deferral. So what are you postponing here? You are postponing the provision of the performance obligation. So you are postponing the delivery of merchandise. You are postponing the provision of the service, even though you've received the cash already. So somebody has paid you, you just haven't provided your end of the bargain. So, for example, maybe you want to cheat on a homework assignment, and then you contact a genius like me, and we work out a deal. You're gonna pay me $10 for this homework assignment. So you pay me the $10, maybe cash app me or Venmo, whatever the kids are using these days. I don't know. But anyways, so you give me the $10, and I'm a procrastinator, as they say. I'm lazy, so I don't deliver this paper to you right away. I say, well, I need a little bit more time because I have so many other cheating sons of bitches out there. So um, I can't recognize that $10 as revenue quite yet. Even though I received the cash, I can't recognize it as revenue. So what I would do is debit cash, that's the initial, okay, that's when you paid me the $10. Again, you won't see cash in adjusted entries. And then I would credit an account called unearned revenues, which is a liability in this case because I still owe you that $10 until I provide you with the answers to this homework problem, or I solve this homework problem for you. Okay? Once I deliver the homework problem to you with all the answers, and you will get an A because I am perfect, Mr. 4.0. Okay? Anyways, once I deliver that to you, then I can recognize the revenue. And here is that adjusted entry. That adjusted entry would transfer that liability, okay, and unearned revenues. So I would eliminate that liability. I would debit unearned revenues, and I would credit service revenue in this case for the $10. So now I can recognize the revenue. Accruals. For accruals, adjusted entries, again, it works in revenues and expenses. Accruals are advancement. So, in terms of revenues, we are advancing the provision of the service or the performance obligation. Okay? So, we have completed our end of the deal, but somebody has not paid us yet. Okay? So, for example, let's go with that example again of the cheating sons of bitches. Okay, so in this case, I give you the answers. Okay, I solved the problem for you, but you haven't given me the $10 yet. In this case, I will still have to recognize the $10 as revenues because my performance obligation is done. Weird, right? But this is how it works, and it makes sense, right? Because why? When it comes to the financial statements, these customers, even though they haven't paid you yet, you provided the performance obligation. So your revenue was earned. Was earned, right? And you should display that to the people on the outside looking in. So when an investor comes to look at your income statement, they can say, well, this company did generate this much revenue, and then they can look at your balance sheet also, and they can go back and forth because the other side of that is an accounts receivable for these accrued revenues. So for this journal entry, the original one would be an accounts receivable. You would open up an account for this individual that hasn't paid you yet, and then you would credit service revenue or sales revenue, whatever the case may be, and you would recognize that revenue, so it can go on your income statements and respective balance sheets as far as accounts receivable. So that people outside looking in, if it happens to be at the close of the year and you're issuing these financial statements, then they can see that you've generated this revenue. Okay. Then when it comes time to that adjusted entries, that adjusted entry would be when this customer pays you finally, it would be a debit to cash and a credit to that account receivable. Okay, you no longer have to have that account open for that individual because they paid you, and that's all. Sorry, I'm yawning because accounting is so boring. God, I'm sleeping hearing my own voice. That's how fun accounting is, right? Anyways, accrued expenses. Let's get excited. Come on, coffee. Okay, accrued expenses as far as accruals. What are you advancing here? You are advancing the use or consumption of these expenses before you pay for them. So, what is an example of an accrued expense? Let's say you have a job. You started the job at the last week of this month, okay? But the company does not pay its employees until the second week of the next month. Okay, so the time period ends this month. Okay, at the end of this month, that's their time period, and then they're not gonna pay their total employees, even though you started the last week. But there's a lag here because you just started. They're not going to pay their employees until the second week of next month, okay? But you still work for that last week, right? So what happens is they incur this expense. They have to remind themselves, okay, at the end of the month that they owe you for that week of service for the last time period, right? The last time period, the last week of last month. They have to incur a liability, so they would credit a liability, and then they would debit an expense account. That's that adjusted entry. That is the adjusted entry at the end of that month that you started. Okay? Then when it comes actual pay time, then they would eliminate the liability, and then pay you your money in cash. Okay, check is cash. Okay, so that's just an introduction to deferrals and accruals. Hopefully that made sense. In the next accounting video, we will take a look at examples of all of these, and it'll make way more sense. So subscribe, like, whatever. I'll see you in the next video.